Back on Newsmaker, just 6 years ago, a 30-year mortgage dropped to 3%, and many Americans jumped at the chance. A 30-year mortgage today is double that, right around 6%. Rates have been falling recently, but for many who might want to consider other housing options, leaving that low interest rate in the threes is an agonizing decision. Trevor Halpern is the CEO of Halpern Real Estate Residential at EXP. He's a Phoenix native, graduate of ASU's College of Law, and the #1 independent agent at EXP Realty in Phoenix. Trevor, thank you. Good to see you.
Great. Thanks for having me.
Okay, you call this, I had to laugh, you call this the golden handcuffs, having that low mortgage rate and then thinking, I can't move now, I'm doubling my rate if I move.
That's exactly it. These are conversations I have with my clients all the time. You get locked into a 2 3/4 or a 3% or the 3.5% rate, and you're looking at 6% nowadays. The natural inclination is to say, I'm not moving. I can't give up this rate.
Do you kind of tell them historically that even 6% is that's a great number? I mean, in the 80s, we were around 15% or even higher for a mortgage. People, who weren't around then can't even imagine that. So historically, 6%, that's not bad.
Exactly. I mean, 6% is trending right along the 30-year average for 30-year fixed mortgage rate. So you're doing pretty darn well. And right now, I mean, even yesterday, we saw rates dip into the high fives. And traditionally, when we see rates solidly in the fives, as mortgage lenders like to call it, a five handle, when we're in a five handle, we're going to see activity pick up dramatically.
We've got right now across the country, and it kind of stunned me, the glut of homes out there for sale, and the Sunbelt states are really feeling it. Phoenix, Austin, Vegas, these kind of, destination sunshine markets have a glut of homes out there. What's going to cause people to finally move? Do you think it is that move into the fives?
Yeah, I do. Here in Phoenix, we have a supply and demand imbalance. We have more supply than we do have demand. So the only thing that's really going to balance that out, or one of the mechanisms that can balance that out, is mortgage interest rates dropping. So if we solidly get into the fives, let's call it 5.5, 5.25, we are likely to see more people, more buyers enter the market. Now, buyer beware. As interest rates, the traditional thought is when rates go down 1%, so let's say from 6 to 5, 1 million buyers across the country are going to activate. And when they activate and buyers go out and start gobbling up the inventory, it applies upward pricing pressure. So as you're waiting for interest rates to go down, you may wait for interest rates to go down, but you might be buying the same home at a more expensive price. And now you're looking to say, okay, well, what does that do for me on a monthly price basis in my mortgage payment? And sometimes it's a wash. So it really depends on rate and it depends on price. But if you wait too long and activity rears its head and people start gobbling up inventory, we can expect prices to go up.
That is really interesting. Yeah, it was only a few years ago we were in a pricing war with every home that came on the market. It was just going up, 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 up.
Yeah, it was crazy. I mean, back in the COVID days, as a real estate practitioner, I often had people say, man, it must be good to be in the business. And I was like, I'm not sleeping. I'm not seeing my kids. There was so much activity. And, we'd hold an open house and 35 people would come through in a day. And we'd have 3, 4, 5, 6 offers per listing and have to manage it all. So, it was good for consumers who captured a great property at a great interest rate. But it all has its pluses and minuses.
Before we get into the golden handcuffs issue, tell me right now, what is the average home in Phoenix? How long is it staying on the market?
It is so predicated on area, area, neighborhood dependent. What I will say broadly is that the neighborhoods in the central part of town, homes are selling more quickly than the outlying areas. And when we look statistically, we see areas like Buckeye tend to have a longer day on market and tend to be more of a buyer's market than some of these central neighborhoods in Phoenix. And that's always kind of been the case with Phoenix. You drive out, they used to call it drive till you qualify. You move further and further until you can qualify for the home. And once things constrict a little bit, people want to be back in the center of town. And so we're seeing the demand in the center of town higher, which means days on market are lower in the center of town than they are on the exterior.
Is it a couple of months? Is it 37 days? What is it right now, just on average?
Yeah,
Do you have a number?
We're looking broadly, let's call it about 60 days.
This golden handcuffs issue. Somebody's got a mortgage in the threes that they got years ago, probably around the COVID time, right? That would have been the sweet spot.
Yep.
So now they're maybe older. Kids have moved out, let's say. Not that I'm speaking from experience. But you might be thinking about other options, downsizing, moving somewhere else, looking at a smaller place, whatever. And they say, I can't give up this rate. This rate is historically low. How do you guide them on that?
Yeah, that's a great question. These are conversations, again, I have frequently. And I always try to encourage my buyers and sellers, regardless of their financial situation, their rate, their scenario, to balance logic and emotion. So if you are just in a logic mode and there is no emotion, or the emotional quotient is low and the logic is high, you're not in what I call the decision-making zone. So I always encourage people to balance that logic and emotion. So think, okay, I'm at 3% or I'm at 2.5%. My logic is up on this. I have to stay. My monthly payment is super low. But you go, my home doesn't serve me anymore. I hate driving home. I hate the street I live on. Or, we have a big home and we're empty nesters now. Or we bought this house and we had no kids. Now we have 2 kids and it doesn't serve us as much. And those two things, that logic and emotion, have to be balanced so you can make sure that where you lay your head at night is appropriate for your current life scenario.
That is so well put, because, sometimes everybody's kind of arguing, take the emotion out of it. You're saying that a home purchase is a very emotionally attached decision, and you should let that be part of it.
Absolutely. Those things should be balanced. I mean, buying and selling a home is a rare time in the American life where you should be balanced.
Okay, Trevor, just break down the numbers for me. I haven't done the math on it. Let's say you're at a 3. You got it at the very lowest. You've got a mortgage on a, let's say it's an $800,000. Let's round it off. Okay, let's just say a $500,000 home. That's close to the median in Arizona. It's a little lower than that. $500,000 home at 3%. Versus a $500,000 home at 6%. How much more are they going to be paying monthly for that?
Yeah, well, that's a great question. I'd have to bust out my mortgage calculator to nail it exactly. But can I give you a very similar scenario?
Sure.
Okay, so if you buy today a $500,000 home at 6%, and let's say you've got that mortgage payment roughly around $3,200 a month with insurance and taxes and whatnot. If you waited until interest rates were down at 5, you can anticipate that home likely costing about $525,000. So if you waited for interest rates to go down and you bought an asset that's a little bit more, now you're going to be spending about $3,100 a month. So your wait, all of that waiting for interest rate to go down,